Hello friends. Welcome to Anhad channel, where we simplify difficult concepts in accounts, finance, banking, insurance and economics. Today, we are going to discuss an important concept in financial management and banking. Amortization. Let's begin. We will start by defining amortization. The word amortization refers to the systematic repayment of a loan over a specified period through equal periodic payments, where each payment consists of two parts: interest and principal. Initially, a larger portion of the EMI goes towards paying interest, while a smaller portion repays the principal. As time passes, the interest component decreases and the principal component increases. At the end of the loan tenure, the outstanding loan becomes zero. So, amortization is the process of gradually reducing a loan balance by making regular payments that include both principal and interest until the loan is fully repaid. Suppose you purchase a house by taking a 30 lakh rupees home loan for 20 years. Bank has calculated some interest on it. Now you have to repay the principal amount as well as interest. Every month, you pay a fixed EMI. Although the EMI remains the same, the composition of the payment changes every month. For example, in the first month, interest is equal to 20,000 rupees and principal is equal to 6,000 rupees. EMI is equal to 26,000 rupees. After several years, interest may reduce to 10,000 rupees, while principal increases to 16,000 rupees. Yet the EMI remains 26,000 rupees. This gradual reduction of loan through EMIs is called amortization. Amortization provides several benefits. First, it makes repayment predictable because the borrower pays a fixed EMI. Second, it gradually reduces the loan burden. Third, it helps borrowers plan their finances efficiently, and fourth, banks also know exactly how much principal is outstanding at any point in time. Let us now discuss components of an EMI in detail. Every EMI has two parts. First is interest component. This is the cost of borrowing money. It is calculated on the outstanding loan balance. As the outstanding balance reduces, the interest also decreases. Second is principal component. This is the actual repayment of the loan amount. Initially, it is small. Gradually, it increases. Now we come to amortization schedule. An amortization schedule is a table showing the repayment details of every installment. The most important columns are opening loan balance, EMI, interest, principal repaid and closing balance. This schedule helps borrowers understand how their loan decreases over time. Let us take a numerical example. Suppose loan amount is equal to 1 lakh rupees. Interest rate is equal to 12% per annum. Loan period is equal to 2 years. Monthly interest rate is equal to 1%. Assume EMI is equal to 4,707 rupees. Month 1. Opening balance is equal to 1 lakh rupees. Interest is equal to 1,000 rupees. Principal is equal to 3,707 rupees. Closing balance is equal to 96,293 rupees. Month 2. Opening balance is equal to 96,293 rupees. Interest is equal to 963 rupees. Principal is equal to 3,744 rupees. Closing balance is equal to 92,549 rupees. Notice that interest has reduced. Principal repayment has increased, while EMI remains unchanged. This process continues until the loan becomes zero. Formula for EMI is written on the screen, where P is equal to principal, R is equal to monthly interest rate, N is equal to number of monthly installments. Although the formula looks complicated, there is no need to calculate it manually. In practice, banks and financial institutions use software, and in Microsoft Excel, you can calculate EMI instantly using the PMT function, which we will learn next. The amortization schedule can be seen on the screen. This table clearly demonstrates the key principle of amortization. The EMI remains almost constant throughout the loan tenure. The interest component decreases each month. The principal repayment increases each month. And The outstanding loan balance gradually reduces to zero. We can also calculate EMI in Microsoft Excel. Microsoft Excel provides a built-in PMT function to calculate the equated monthly installment, EMI, quickly and accurately. The formula or PMT function syntax that we can use is equal to PMT bracket open rate, NPR, PV bracket closed, where rate is equal to monthly interest rate. NPR is equal to total number of monthly installments. PV is equal to present value or loan amount. Note, the monthly interest rate is calculated by dividing the annual interest rate by 12. As you can see on the screen, in Excel write as followings. In cell B1 write loan amount which is rupees 1 lakh. In cell B2 write rate of interest converting it into monthly rate which will come to 1%. In cell B3 write time period in months, 2 years, will be 24 months. Step 2. Enter the EMI formula. In cell B5 type is equal to PMT bracket open B2 B3, B1 bracket close. The result will give EMI which will be 4,707 rupees and 35 paise. Now the question arises, why is the loan amount written in cell B1 written in negative? In the PMT function, the loan amount is entered as minus 1 lakh because it represents cash received by the borrower. Using a negative value makes the EMI appear as a positive payment. Amortization is commonly used in all kind of loans, whether they are home loans, vehicle loans, education loans, personal loans, business loans or mortgage loans. Some people often confuse these two terms. Amortization and depreciation. Amortization applies to loans and intangible assets. Depreciation applies to tangible fixed assets. Friends, with this we come to the end of today's session. We hope you liked this video. If you found this video useful, please like, share and subscribe to our channel. On this channel, we regularly upload educational content on economics, finance, banking, insurance, financial crime, GST, income tax, accounting, financial management, and investment management in a simple and easy to understand manner. Please explore the channel for more topics as per your liking. In case you want a video to be created on any new topic, please write in the comment box. Don't forget to press the bell icon so that you receive notifications whenever we upload a new video. See you in the next video with another interesting and informative topic. Till then, bye and take care.